Hi everyone, this is Nihala Nazir, your ACCA tutor, and today we are going to discuss about IAS 40 investment property from FR. To simply put, investment property is basically those assets which you are not using as an IAS 16, or let's just say which you are not using it for your business purposes. Okay, so rather than that, you are actually using a property so that you can gain capital appreciation from it, or you can rent the building out and receive the rental income. Okay, so this particular arrangement is the investment property. So you're not using the asset, you're not using for any of the business purposes at all for that matter, but you are looking forward to its capital appreciation, or you are looking forward to rent it out. So those kinds of assets are called IAS 40 investment property. The recognition criteria is same as IAS 16. That is, the first one is that if you're going to get the future economic benefit, then first criteria is met. Second criteria follows where you can have a reliable estimate of the asset. Okay, that means you can measure the cost of the asset reliably. Now, when we look into the measurement is also same as IAS 16. That is, you have two types of measurement. One is the initial measurement and the other is the year-end measurement. And initially, you're going to record the asset at cost, same as the IAS 16. In the year-end, you have two methods, that is cost model and fair value model. So in IAS 16, you have got revaluation model, but here you have got fair value model. Okay, so cost model, you're going to convert the cost, okay, but you're not depreciating the asset. Instead, in the year end, you're going to convert the cost into the fair value. Clear? So if the fair value model is used, whatever fair value gain or loss you have, you're going to record it in SOPL instead of getting it into OCI. Okay. Now, there are something that you need to notice. Whether or not you can change the method or model of valuing the asset depends upon certain circumstances or condition of the asset. Okay. So if there are exceptional cases where you can't use a particular model, you can change the model. Alright. Now, all these things depends upon the judgment of the accountant. So if the accountant feels the fair value model is right, then he can choose so. If the accountant feels the cost model is right, where the asset is recorded only under its cost, then the accountant may do so. Alright. Now, all the investment property under the same category should use the same measurement model. Alright. Now, if you have a carrying value, it should be changed to its fair value. It can be, or should I say, it can be changed into its fair value, but not the other way around. That means you can't change a fair value into a carrying value. Now, when it comes to transfer of investment property, we have four cases especially. The first case is where you're converting an IAS 16 asset to an IAS 40 asset. That means an asset which you have been used is going to be changed into a rental property. Okay, just for reference. So the treatment is divided into three time periods. The first time period is the until the date of transfer. That is, the transfer hasn't occurred yet. So until the date of transfer, what do? So until the date of transfer, the asset is still IAS 16. Okay, the asset is not the asset is depreciated. Okay, and any revaluation gain or loss that you get from the asset is taken into OCI. Okay, now the second time period is when at the date of transfer, that is the day in which you are going to transfer. So see, the asset's fair value would be calculated. Okay, and the asset is shown under its fair value. Okay, and the gain or loss is still the revaluation gain or loss, and it is taken into OCI. So that is the treatment. Now the third time period is after the date of transfer. So once the transfer is over, the asset is now IAS 40. It is not depreciated. Okay, and the gain or loss is going to be the fair value gain or loss, and it is treated in SOPL. Now the second situation where you have been renting out a property, that is IAS 40, and you have decided that you're going to use it, that is you're going to change it into IAS 16. Now the something I forgot to mention is that IAS 16 is measured under revaluation method, and IAS 40 is measured under fair value method, right? So accordingly, the gain or loss that we take changes as mentioned before. Now coming back, the second case scenario, I repeat, we are transferring the IAS 40 into IAS 16. That is, IAS 40, which was used under a fair value method, is converted into IAS 16, which is used under revaluation method. So treatment, the time period is same. The first time period is the until the date of transfer. The asset is still IAS 40. There is no depreciation. And at the date of transfer, the asset is going to be valued at fair value, okay, and gain or loss is still treated under SOPL. Now the third time period, that is after the date of transfer, the asset is going to change into IAS 16, depreciation is done, okay, and the revaluation gain or loss is taken into OCI. Now the third case scenario is when your investment property, that is IAS 40, is changed into inventory, that is IAS 2, IAS 40 to IAS 2. Okay. So till the date of transfer, you're going to use fair value, okay, and all the subsequent measurement would be taken under the rulings of IAS 2. Now the fourth case scenario is from inventory to the investment property, that is IAS 2 to IAS 40. So while you're converting IAS 2 to IAS 40, there would be a change in the carrying value, and it should be shown as profit or loss and is taken into SOPL. So that's it for a summarized version of IAS 40. So if you are enrolling in my classes, I'll be going in detail with the problems and the methods that you can attend the exams with. This is not just the paper I attend. I also take all the foundation level. And also if you want, the time is flexible, and also I take all the F level classes as well. So read the description below in order to find the details about the classes. Thank you.